So my top three things today are going to be just that. Number one is going to be, is this a calm before the storm, and where are we going from here? What am I looking out for? Number two is going to be tech, and the fact that tech is absolutely on a tear at the moment. And number three is going to be the quads. I'm going to talk about the quads again. You all know that I have a full cycle investing strategy, and the quads play a big part in that and in guiding how I invest the money that I manage. So your money. So first of all, let's just jump into the calm before the storm. One of the things I wanted to cover today in this calm before the storm, and I'll talk about this a little bit more in tech, but just check this headline out right here, which is the S&P 500's return to a record doesn't tell the full story, with 60% of stocks still with losses. Now, one of the interesting things about an index is if you look at the S&P 500 index, the NASDAQ, any number of indexes, there's going to be a way that index is constructed and weighted. And at the moment, the S&P 500, let me just see if I can move this bubble out of the way here and show you okay, well, actually, no, that's not the one I wanted. Here we go. This is the one I want. So if you look at the S&P 500 constituents, one thing you're going to notice is that out of the top 10, let's say, the top even 5 or 6 are technology companies. Microsoft, Apple, Amazon, Facebook, Google. They're all there in the top weighting of the S&P 500. It is no wonder the S&P 500 is hitting new highs, because all of these stocks are at new highs or going in that direction. It is just amazing to see that. There's also talk, which is one of the reasons why Tesla stock is ripping at the moment, that Tesla may be added to the S&P 500. Who knows what weighting it'll get, but anyway, that's one of the things that's been driving Tesla stock. But nevertheless, one of the things I just wanted to point out was that a lot of this return in the S&P 500 index has been driven by the technology sector. You could also see this this is the top 10 holdings of the Qs, the QQQ ETF, which is the Invesco. It's basically a technology ETF. And again, if you look at the top holdings, there you go. Apple, Microsoft, Amazon, Facebook, Google, right? All the FANG stocks. And plus Netflix, right, is in there too. So, and there you go. And Tesla's there as well. So again, one of the reasons why we're hitting all-time highs in tech, all-time highs in the S&P 500 is because of the leadership of that particular group of stocks. Now, that's very dangerous as well. And I'm going to show you some stuff in a minute when we talk about tech. But I just wanted to, because I'm sort of saying this is a calm before the storm, one of the issues that we've got is, again, earnings are troubling in a lot of the sectors of the market. I've shown you the table of earnings. We've had negative earnings growth this quarter. We'll probably still have negative earnings growth next quarter. Not in all segments of the market, of course, but in some of the biggies. And so when I'm sort of saying to you, this is the bit of the calm before the storm, let's put this into perspective for a second. What's actually happened? So at the beginning of this year, the beginning of 2020, we were ticking along. The economy was slowing. There was no doubt about that. You could see that happening. Earnings were starting to, growth was starting to decline. GDP was starting to decline. A number of other things were starting to sort of decline. But it wasn't a, off the cliff kind of decline. So we were preparing for that. We were preparing for sort of a quad 3 type environment. Then we have COVID hit. Now, COVID shut the economy down. Right? We all know that. It shut the economies of the world down. Everything just ground to an absolute halt. And from sort of March, April, May, we had all this uncertainty, all this economic shutdown, all of this really bad stuff going on, and probably you could even argue parts of June. We started to see the reporting coming through. So we're at the end of August now. I can't believe we're already 2/3 of the year is almost gone, but we're at the end of August now, getting into September, and we're having the data from that period of sort of May, June, July being reported. And of course it was bad. We had GDP numbers in the US bad, Australia bad, rest of the world just bad, just a lot of the data bad. But the economies of the world have begun to reopen. And of course we've now had the second round of coronavirus come through, because people are back out and they're interacting and they're mingling, etc. So of course the transmission rate of the virus is going to rise. Anyway, the thing I want to highlight here is September, October, November, December, all this whole back half of this calendar year is going to be really interesting to watch. It's one of those things where I think there needs to be some caution because we don't really know what the effect of the mortgage payment pauses, the job seeker, all of that stuff are really going to have on the economy. We also don't know that well, first of all, we do know that the economy is not going to reopen and go back to the way that it was prior to COVID. The changes are going to be made. We know there's more health, what am I trying to say? Concerns and restrictions and things that they're going to do around that, social distancing, all that stuff. We don't really know what the long-term effects are going to be on the economy. So this idea that's been talked about, and I've talked about in these updates as well, that we're going to have a V-shaped recovery are ludicrous. But we're in this period right now where we've sort of had the crash, we've had the reopening, which has seen, unemployment has dropped, people have gone back to work, the economy's sort of gotten a little bit better. We're starting to see things beginning slowly to improve and improving, but we don't really know for sure what the long-term effects are going to be. So cautious optimism, I guess, is what I'm saying. We do have parts of the global economy, I'm going to get to this in a second, that are performing well and that are improving. And I think to some degree that's going to be what drags Australia to Quad 2 pretty much for the rest of this year. So anyway, I just wanted to sort of highlight that because when you're looking at indexes and you're looking at stock markets and you're seeing a lot of these things just really ramping and going higher and hitting new highs, one of the things you have to be probably know about is and be aware of is the constituents of the indexes and why perhaps you're getting these all-time highs. So I've covered that off. Now, I just want to move into just real quick, I want to touch on debt. This is I don't know if you've seen this, but the usdebtclock.org is this a fascinating website, and it actually has many countries on it around the world that produce reasonable data around their national debts. But as you can see here, the U.S. national debt currently is sitting at $26 trillion. And this is over 100% of their actual gross domestic product. So GDP, probably end up being, I don't know, a little over $20 trillion this year, 21, 22, something like that. But the national debt will probably have ticked up to 27, 28 trillion by then. Juxtapose that against Australia, and we actually only have a national debt of 649 billion. Not too bad, I suppose. It's still a shit ton of money, but it's a far better position from a national point of view than the U.S. So one of the figures that you look at here, the ratios, is the public debt to GDP ratio. We're only at 46%. And I've said to a number of people who I've conversed with about this, is I've said Australia's actually in a pretty good spot here because we can, if necessary, borrow more money. We can increase the national debt to try to get us out of this problem. And part of that, of course, is the fact that our public debt to GDP ratio is only 46%. Other countries that are currently doing really well, I mean, Indonesia, I've talked about that. As you can see, they have a pretty low national debt compared to their GDP. Norway was another one we've recently owned, again, looking at 41% of national debt to GDP. Russia is another country we've owned that I'll be looking to get back into. Anyway, I think you probably get the point about debt. And the final thing I want to say about this is just to show you this chart around debt and one of the reasons why we've seen a lot of asset price in reflation, and we're going to see inflation probably coming down the pike. Have a look at this debt. This chart. This is the U.S. Federal Reserve's balance sheet from 2007-ish through to today. And what you can see on this chart very clearly, you can see the response to the GFC. You can see the continued growth of the Federal Reserve's balance sheet through the sort of period of time when they were trying to reflate assets. You saw them where they were trying to curtail the Fed's balance sheet and ultimately what that did to markets. And then finally, you see the response from COVID and the massive ramp in the U.S. Fed's balance sheet. So the Fed's balance sheet prior to GFC was 850, almost $1 trillion, right? Popped up to about 2 trillion, a little over 2 trillion. That was a pretty big deal back then. Came off a little bit, but then really the Fed just had to keep printing money, keep printing money, keep printing money, keep reducing interest rates, such that the Fed's balance sheet peaked at about $4.5 trillion, somewhere in that 16-17 period. And they started to try to pay that off leading into sort of the end of 2019, but that didn't work so well. You may recall that they, were talking about raising interest rates, doing this sort of stuff, and the market didn't really like that, so it crashed. And then we, of course, had COVID, and the Fed's balance sheet has ripped higher. The reason I'm showing you this chart is to just reiterate the fact that the U.S. in particular is printing and spending money with reckless abandon. They are throwing money at people. And it's going to have a temporary impact, of course. We're going to see a temporary lift in a number of things in the economy. But will it be permanent? The reality is it probably won't be. And part of that is because of the change that we're going to see as a result of COVID, the structural changes in the economy. Remember, we've got a lot of people unemployed, both in Australia and around the world, especially in the US. My question is, are these people going to be going back to full-time employment? Well, time will tell, and we might get back to that point, but I think it's going to take years to actually return us to the same or similar structure of our economies that we saw before. So I guess I just want to remain reasonably cautious still about what's going on out there, because one of the things you've heard me say before is, and this has been a while since I've said this, but risk tends to cluster, volatility, in other words, clusters, and it's episodic. So we've had, and I'll cover off this just in a little bit here, but we've had declining volatility and a number of volatility metrics come back down, which is great because it means that stock markets and things are doing well. But it also means that we could be setting up for another period of increased volatility. I'm not calling for that. I'm not saying that is what's going to happen, but I'm just sensitive to the fact that we've had all this money printing, we've had a lot of debt created, we've had a lot of government stimulus, and they're trying to get us out of the poo economically, and it could backfire. We could have something else, another black swan, come down the pike and railroad that. So anyway, let's move on to tech. So I mentioned a moment ago the composition of indexes and the fact that the S&P 500 and the NASDAQ, or the Qs rather, the Invesco Triple Q, which is basically a NASDAQ index, composed index, has a number of the leaders. The current leaders in the stock market are technology stocks. Apple, Microsoft, Amazon, Facebook, Netflix, Google have all been on an absolute, and Tesla for that matter, have all been on an absolute tear to the upside. They've done very, very well. And this is part of the reason why the S&P 500 has been hitting new highs. But as I was talking about a moment ago, there's still a large portion of that index that is not doing well. And these would be your industrials, a number of your consumer discretionary type stocks, your energy, these sorts of components of the index have been doing horrendously. Anything that's interest rate sensitive at the moment has been doing really well. And tech is just one of those asset classes that does well in quad 3. It also does reasonably okay in sort of quad 2, but it's not necessarily an overweight in quad 2, but it is a place that you want to have some cash allocated. Nevertheless, we've been invested in tech and real estate and gold and silver and some of these other consumer grocers and things of that nature over the last, let's say, 6 to 8 weeks. I did take some money off the table. I just quickly move off the table with regards to gold, and there's a reason for that. And actually, since I brought it up, I might as well put up the table again for you. And it has to do with the correlations. You know, I talk a lot about this correlation table. And again, we're seeing a pretty tight correlation between the U.S. dollar and a number of other things, gold, the S&P 500, etc. And of course, the U.S. dollar has, in the last week or so, popped a little bit. It hasn't really gone, crazy, but it has popped a little bit, which is why we saw gold come down and silver come down and gold miners come off a little bit as well. So I'm actually looking for the opportunity to re-enter all of those positions, because longer term, we're still going to see gold, silver, the miners, those stocks doing well, because we're in the reflation and inflation part of this whole story. But just to wrap off on tech, the other thing I thought I might share with you, which is quite interesting, I show this table once in a while. It's the implied and realized volatility. Not to get into a big explanation of this, but when I show this chart, the main thing that you're looking for here is stuff that is green means that people are generally, and this is generally a measure of the puts and the calls that people buy. If you don't know what those are, don't worry about it, but it's kind of a measure of risk. And the higher the green number, pretty much means that the more fearful people are. And generally when people are fearful, there's a saying out there that bull markets climb a wall of worry. And so generally when people are more fearful as an expression of the implied volatility metrics, it means that there could very well be more to run in that particular market. Commensurately, when there is a negative number, and when it's like really negative, it means that people have become complacent. So they're buying more calls, less puts, this sort of stuff, and it often can mean that the market may be reaching a topping period, whatever. It's just, again, it's one of those things we have to be concerned about. So I'll just draw your eyes to this bottom portion here, which is kind of a new addition to this report, which is the big tech stocks. Now, 4 out of the 5 tech stocks, a month ago, people were shit scared about these tech stocks. And that's why they've continued to climb that wall of worry, why we're hitting new all-time highs in Apple and Amazon and Facebook and Microsoft. But check this out. We're starting to see implied volatility discounts creeping into tech. So Amazon, Apple, Microsoft, and Facebook all have implied volatility discounts. What that means is people are getting complacent now. They're like, they're probably thinking, tech's just going to keep going, and I'll just keep buying tech, keep buying these stocks, and I'm on to a winner here, and we'll just keep on winning. So again, this is one of those things when you're an investor in markets, it's not one metric that you look at to say this is definitely going to happen, but it tells a bit of a story. Now, these stocks are also what's called momentum stocks, which means that as Newton's law suggested, once an object in motion tends to stay in motion until an equal and opposite force hits it and knocks it into a different trajectory. But look, all I'm really saying here, and I'm highlighting this, is that tech it's been doing very well. It is a quad 3 core holding. It's also kind of a quad 2 core holding. But if we get a correction in tech, I'm going to buy some more, I guess is all I'm saying. And what this kind of metric implies is that we could see some sort of correction in some of these stocks. So anyway, it's just something to look out for. Another one that I often show and that I talk about, that doesn't have any red or green arrows on it, is the commercial commodity futures trading positions for non-commercials, which is basically, when you say non-commercials, is all the people that are out there in the market trading. And one of the things potentially to highlight here is when it's negative, it means that, again, people are generally betting against a trend sort of continuing. And if you look at the NASDAQ index here, you see that it's an relative to itself, people are short the NASDAQ. So again, they're climbing this wall of worry. They're thinking that it's going to end. They're trying to hedge or whatever. I don't know exactly, but they're just thinking maybe this is going to end. And that in and of itself can precipitate the continuance of the rally in some of those things. Likewise, if you look at something like the US dollar, and by the way, a Z-score is a mathematical term for something relative to itself. So when you see extremes, plus or minus, anything over plus or minus 2, that tends to represent an extreme. So let's see if I can just find something here that is sort of representative of an extreme at the moment. Here you go. U.S. Treasuries. So this, as of this report, which I think was probably it's about a week. It's probably a little bit more old. It's probably a little bit older than that now, this data. But nevertheless, you look at a negative Z-score of U.S. Treasuries, people basically aren't thinking that interest rates can go any lower. That's what that is an expression of. And market participants are usually wrong. This is the thing, right? So that is a huge negative Z-score. And what it is telling, and then of course you can see it in the 2-year as well, where they're also not by a large number, of course, but interestingly, there's some divergences where the 10-year and the 5-year have got positive Z-scores. So anyway, look, the point is this would be probably a 30-year. The U.S. Treasury would be a 30-year T-bond. And look, I'm rambling a bit here, but the point of what I'm saying is that when you get these extremes, again, they're usually wrong, and it gives you ammunition such that for traders to unwind those positions, it's going to drive interest rates lower, I guess, is the ultimate conclusion here. And so some of the other things to probably have a quick look at gold. It has a negative Z-score. That's a good thing for gold. Now, during this week, we might have seen that position reverse. So the problem with this data is that it's usually a week to 10 days old because it doesn't get published with great frequency. I don't know why, but anyway, just a little bit of a lesson there on some of the things that I look at as a trader. Now, let's just talk about the quads, and so I can wrap this up for you guys so you can get back to enjoying your weekend. Here is a current quad map of a number of countries. I think this is 50 countries. They're quad maps. This starts off sort of third quarter forward to the second quarter of 21. Now, as you can see, and I've been talking about this, Australia no doubt was in quad 4 this past quarter, looking likely that we're in quad 2 and then quad 1 and 2 going forward. So this is a great sign for Australia going forward, I think. And I was having a conversation with a client the other day, and they were just asking me, we were talking about, our economic prospects, what was going on. I said, I actually think that we might be surprised in Australia as to the strength of our economy. And I think part of that is going to be off the back of China. Now, I've talked about China before, but you could also lump into that just the Asia Pacific region. So if you look at countries like Indonesia, which again I've owned before, they're in some good quad action here. India is looking like it's going to be okay and growing again. I mean, look at New Zealand, for crying out loud. New Zealand, they did a great job of sorting out the COVID thing. They're doing well. Philippines, not so much on the Philippines, but still doing okay. And I think that was about Taiwan and Thailand, 2 other big powerhouse sort of economies in our region that, again, entering that quad 2. So what we're seeing in the Asia Pacific region is a lot of economies have gotten out of this COVID situation and are growing. And so that, I think, is going to mean more demand for Australian resources, copper, iron ore, all that sort of stuff. And that's one of the reasons, I suspect, why Australia's projected growth is looking much better than maybe what some people might be thinking. Notwithstanding the fact that anything could happen going forward, but at least at the moment, the numbers are suggesting that we're going to see a return to growth of GDP. I've shown some charts on that previously. Actually, I might even have that open. Let me see here. Actually, yeah, here it is right here. So what you'll see is we had a massively negative quarter. I don't know that we're going to have another negative quarter of GDP, so we might actually technically avoid recession. Who knows? But then we're climbing out of this. So that is something that's bodes very, very well for Australia. Anyway, that's probably enough of an update for this weekend. There's not a lot else for me to say except for I'm looking for opportunities to buy back into or buy or add to some of these positions in the Asia Pacific region. Get back into gold and silver. I think this week coming up may be the opportunity to do that because the U.S. dollar might be showing a little bit of strength during this week, and because of that correlation between gold and silver ultimately and the dollar, we might get a good buying opportunity. We're actually fairly close to the low end of risk ranges, so there's not probably a lot of downside left in gold and silver and the gold miners. So anyway, we'll see what happens there. And then finally, as I say, I'm monitoring and watching this tech position to see when it might be time to maybe take some profits and get out. But the reality is they've been fantastic momentum stocks and have continued to go higher. So they'll probably just continue to go until something comes along and knocks them off their perch. Who knows what that'll be. Anyway, hope you are having a great weekend. I'm heading home now to start cooking some dinner and stuff. So I'll catch up with you guys next week and give you a bit of an update. Have a good one. Bye-bye.